Let's get into the outlook for private credit for 2026. And Zagga CEO and co-founder Alan Greenstein joins me here on set. So is this going to be playing a growing part of what we see in terms of trying to meet our housing targets as well?
Hello, Juliet. Thanks for the invitation. Yes, I think so. I think that private credits, Australian private credit specifically in real estate, is now playing a much more important and powerful role in the funding waterfall. There's no doubt that private credit is now becoming part of the mainstream. I think certain of the players are definitely mainstream, much larger than some of the other financial institutions out there, like regional banks or small building societies, so they are massive contributors. I think that borrowers now regard private credit as a place to get money from developers, from funders with integrity, funders with expertise. So for sure, private credit is now in the mainstream, and in that regard, to the extent that it is becoming more attractive and more people are looking for private money, it is certainly contributing to funding the housing shortfall.
We are seeing, though, a regulatory lens on private credit intensifying. Is that good in your view?
I think it's necessary. And I think it's necessary for a few reasons. Firstly, we understand that ASIC's concern is the number of retail investors going into private credit. And as we understand with all investment products, you really need to be able to choose the investment product that suits your investment strategy best. And we can understand that the way that private credit is often structured may not suit every retail investor. So I think that from that point of view, one can understand why the regulators all over the world want to make sure that private credit is offered with more transparency, with more discipline, with perhaps more rules around it in a more structured framework. So from that point of view, we support the regulation. However, we also believe that not all private credit is created equal. And on that basis, you can't really have a one rule suits all scenario. And it needs to be tailored or structured for where the various players are in the market.
So how are you seeing that transition go from, I guess, niche to mainstream?
Yes, so I think, for a business such as ours, which is now almost 10 years old, which started at nothing, we've now written more than $2.5 billion worth of transactions. We have 1.3 billion of assets under management. We expect that to grow. We understand that even in our own journey, we have had to become more disciplined, more transparent, more structured, as we've met the need for larger sums of money from our borrowers. So I think just normal sophistication in the normal scheme of getting bigger and getting more attraction for more borrowers requires you to up your game. So I think from that point of view, we all naturally need to up our game. That said, there are certain parts of private credit which are common to everybody, and we all need to conform to a standard around that.
With the growing interest from international investors, how much do you welcome that? How much is that helping private credit too?
I think we need to accept that Australia is an attractive place for overseas money right now. And we're seeing a lot more overseas money come into Australia as it's leaving places like the US and Europe. So it is fantastic that those overseas investors have decided that Australia is an economy and a market in which they should be investing their money. But when that money comes here, it also means that that money becomes a lot more selective because there's more of it in the market. And that means that standards, disciplines, and sophistication needs to be increased to meet the demands of those investors who may be more sophisticated than us or more sophisticated than what we're used to. So we welcome the money, but we accept that that money is going to seek the highest level. That may drive consolidation, that may drive different kinds of opportunities, and we need to be open to all of those.
Well, speaking of opportunities, you've got a raise with FIG Securities. Tell us about that.
Yes, so this is our second raise with FIG. About 4 years ago, we wrote our first note with FIG, which was for $43 million. So FIG basically wrote a note which it sold to its own clients. That note consisted of loans that had been originated by Zagga. That note was meant to roll out over the next 12 months. FIG approached us and said, they like what we've done. There's been fantastic performance. There have been no defaults. They like the kinds of deals that Zagga has been writing. So they offered to roll the note and to increase the note. So we've increased that note from $43 million to $65 million, and that now rolls for another 4 years. So we're delighted with that.
And where do you think that's going to take you in terms of development and growth?
Well, the FIG note is part of our funding pools. We have other funding pools. We originate quite a lot of money these days from Asia Pacific. We have a fund in Singapore. We have a fund registered in Tokyo. We're looking at some of the other jurisdictions. So hopefully that will take us on our journey to $5 billion assets under management over the next 3 to 5 years.